All right, let's dive right into this explainer. Today, we're taking a fascinating historical journey to uncover these surprising systemic origins of modern wealth and really get to the bottom of the true nature of the corporate balance sheet. So whether you're a student of political economy or, an executive managing these exact types of balance sheets today, this is a truly captivating tale. We're looking at how accounting methods, rather than just raw industry, actually created modern capital. Section 1. When ledgers replace swords, the origin of the asset. Now, historically speaking, power pretty much meant physical violence. It was about the sword. But the source text we're looking at presents a really striking thesis about how that power transitioned. It states, in every epoch of domination, a tool emerges that renders violence invisible. In the modern capitalist world, that tool is the asset. So the author's core argument here is that the modern asset isn't some product of nature or even something organically born from free trade. Instead, it's the result of a kind of accounting alchemy. So what actually is an asset in this context? Well, the source frames it as a category born from that very accounting alchemy, a category that literally translates violence and conquest into numbers, value, and ultimately legitimacy. And honestly, this heavily challenges our typical executive mindset. We usually just think of an asset as, something of value a company owns. But we're being asked to look much deeper here. We need to look at how that value was originally classified and legitimized to begin with. Moving on to Section 2, Sovereignty and Doomsday Logic. Legibility as power. To really understand this shift, we have to look back at how early states used record-keeping. If we go way back to ancient Mesopotamia, early clay tablets were simply used for stewardship. It was about establishing a social memory of who owed what to the temple. But fast forward to 1086 in England, and the ledger shifts into a literal weapon for taxation. Finally, by the 13th to 15th centuries, private merchant bankers in Italy adopted this exact same sovereign tool, which gave rise to private ledger power. The absolute turning point in this whole tale is the Domesday Book. The text actually describes this as the precise moment conquest crystallized into fiscal dominion. William the Conqueror didn't just seize land with swords. He commissioned a totalizing audit of the territory by quantifying every single field, every mill, and literally every human life into a taxable, transferable unit. The Norman elite built a massive extractive machine. They rendered the world legible, specifically so they could tax it and eventually turn it into alienable property. Section 3. Double entry, the central fraud, private ledger power. So this immense power shifted to the private sector around 1494, when a Franciscan friar named Luca Pacioli, who was essentially the grandfather of modern accounting, formalized double-entry bookkeeping. This system created a sort of double-entry metaphysics. The rules were strict. Every credit must have a debit, every loss has a gain, and crucially, every acquisition must be entered as an asset. Suddenly, the messy, physical, complex realities of the world were abstracted into totally sterile, legally enforceable entities. And right here is the core and frankly radical claim of the source material. It states, accounting creates the asset. The asset does not pre-exist accounting. The text argues that value was actually imposed by the ledger. It wasn't just discovered in nature. By organizing the world into neat columns of debits and credits, the accountant essentially performs a magic trick. They mask the deeply moral reality of debt and conquest behind the perceived neutrality of math and numbers. Now, to understand how this works legally, the source traces the asset's DNA all the way back to 3 specific pillars of Roman law. First is res, the idea that the world is made of categorical things available for ownership. Second is dominion, the absolute right to exclusively dispose of a thing. And third, action is in rem, rights that are enforceable against the entire world. Early capitalism revived these exact concepts so the world could be cleanly divided up and verified by the accountant. And it's fascinating because these principles still underpin every single corporate balance sheet today. Okay, let's look at Section 4, Sanitizing Theft into Assets, the moral laundering of the ledger. The text argues that the ledger essentially performs a kind of moral laundering. On one side of history, you have these incredibly stark, often brutal realities. We're talking about the enclosure of the English commons, the vast coercion of plantation slavery, and massive colonial extraction. But through the lens of the ledger, these events were mathematically laundered into sterile, highly respectable balance sheet columns. They simply became real estate, labor assets, and strategic resources. The source presents this as a profound mechanism of systemic translation. The author breaks this transformation process down into 4 really distinct steps. Step 1, what was taken becomes owned. Step 2, what was coerced becomes contracted. Step 3, what was destroyed becomes depreciated. And step 4, what was stolen becomes value-producing capital. According to the source, once an item is entered into the ledger like this, the moral crime is essentially sealed in a coffin of arithmetic. It completely removes the historical origin of the wealth from any further debate. And the thing is, this mechanism, it never actually stopped. It just continuously expands. The source maps out this relentless asset frontier. It started with land as the original capital, then moved to commodifying labor under wage relations. Then it monetized debt as bonds, securitized risk through complex derivatives. And today it's harvesting our behavior and data. The text refers to this continuous conversion of real life into paper claims as enclosure by other means.
Section 5. Why assets lock in inequality. The architecture of capital accumulation.
Now, what's really interesting about this slide is the relentless looping cycle that mathematically guarantees wealth accumulation. It's a simple 4-step engine. Step 1, assets generate returns. Step 2, those returns purchase more assets. Step 3, those new assets collateralize loans. And step 4, those loans finance further acquisitions. It is a brilliant structural engine designed to continuously and effortlessly compound upon itself year after year. When we contrast the reality of wage earners with asset owners, the systemic result is pretty glaring. According to the text, wage earners live by income, and logically, they stagnate over generations, even while being highly praised by the system for their hard labor. Asset owners, on the other hand, live by assets and accumulate wealth passively. They are structurally rewarded by the system. The core argument here is that the ledger fundamentally locks in a very durable inequality. And it's an inequality secured not by kings or armies, but by spreadsheets. So, summarizing the author's ultimate conclusion here, the ledger is sovereign. The true power in capitalism isn't the state, and it isn't even the market. It's the ledger itself. By possessing the power to define what actually counts as an asset, the ledger completely severs ownership from responsibility. It turns markets from places of simple trade into actual mechanisms of rule. What we are looking at is governance, purely by balance sheet. I want to leave you with a final provocative thought to mull over, especially for the executives managing these exact systems today and the students studying them. If governance and our entire societal hierarchy are now fundamentally dictated by the balance sheet, who really holds the power? Are we managing the ledger, or is the ledger actually managing us? Thank you so much for joining me on this explainer. I really hope this historical dive into the alchemy of accounting gives you a completely new perspective on those numbers we all look at every single day.